Hi, I'm Gary Venner, CEO of IFA Acquisitions, and I'm joined by Andrew Bretherton, partner of Keystone Law. Andrew's experience with working with IFA acquirers and sellers, and he's worked with us on a number of deals that we have brokered. Welcome, Andrew. Really, could you just sort of make an introduction, who you are, your company, and your experience in the IFA acquisition space?
Thank you, Gary. Yes, pleasure to be on your podcast today. Always fun working with you. I'm an experienced corporate lawyer, so I do a lot of transactional work, M&A and private equity investments. And in the last few years in particular, I've advised on lots of sales to employee ownership trusts, which is the subject we're going to talk about today.
Oh, that's fantastic. Yeah. And to be honest, I didn't know a huge amount about employee ownership trusts, and they certainly serve a great purpose, I think, for some vendors with the infrastructure in place. So, Andrew, what is an employee ownership trust and what are the benefits of those trusts?
Very good question. Employee ownership trust, I call it an EOT for short, is a specific type of trust to reward employees and encourage employee engagement. It is an indirect form of employee ownership whereby the trust holds a controlling stake in a company for the benefit of the company's employees. The key benefit, or one of the key benefits for the selling shareholders is if they sell a majority interest in a company and EOT qualifying conditions are met, they get 100% CGT relief. So no tax paid by the sellers on their sale proceeds. And the sale should also be free of income tax and inheritance tax, subject to EOT conditions.
I mean, that's
And it's
fantastic.
important that you get HMRC clearance for that.
Yeah, absolutely. And we will run through those sort of qualifications that you need to have, I think, because it's really important. Whoever's going to do this, make sure they do it in the right way. So selling a controlling interest is basically 51% or more. Is that right?
Correct. Yeah.
Fantastic. And that 51% is sold to the trust. It isn't a gift to the trust. It's sold, isn't it?
It's sold. The money comes from the trading company, which effectively makes a contribution or gifts the money to the trust, but the trust pays that money to the selling shareholders. And the key thing here is that the transaction, the price for the shares must be done at market value.
Yeah, absolutely. So from a vendor's point of view, they are not doing this at a discount. They are doing it at market value, and it needs to be shown that, doesn't it? So, Andrew, as we say, it has to be at market value, and that is key. And we can talk more about how we make sure that that is there, and that certainly needs the HMRC clearance that you talked about. But of course, when the vendor sells the remaining shares,
Yes.
I'm right in thinking that that is when the business asset disposal relief and capital gains tax will be applied on that bit only. Is that right?
That's right. Usually, for sales to EOTs, the vendors would sell 100% of their shares because then they get tax relief on all their sale proceeds. If they don't have to, though, so they can retain a minority interest in the company if they want, for example, they think the company is going to grow and get more profitable, they can benefit from that by retaining a small stake in the company, a minority interest. But if they then subsequently sell that minority interest, then that will be taxed in the ordinary way. So you may have business asset disposal relief and CGT at the usual rates.
Yeah, and bear in mind that business asset disposal relief, there is a maximum cap there of £1 million, then that might be quite useful that, the remaining could still stay within that. And as you say, staying involved in the business might be that their remaining shares are valued more if the company continues to grow through that new ownership and more sort of motivation, I suppose, that comes around. So let's talk about the benefit. I mean, there are going to be pros, there are going to be cons, aren't they? Let's talk about the pros. What are the key pros, would you say?
Yeah, so I think there are lots of benefits, not only for the sellers, but obviously the employees. Sales to EOTs are great for succession planning because they provide a very stable and smooth transition. The selling shareholders are allowed to maintain a a management role in the company, an active role in the company going forward, so they can ensure a smooth handover to the next generation. Also provides a simplified and less stressful sales process. As you know, Gary, sales to competitors, private equity-backed consolidators, involves arduous due diligence and often lengthy legal negotiations. And sales to EOTs, in my experience, don't. It's a much more light touch, simplified sale process, so less stressful all round, and also less transaction fees as well, happily, for sellers.
Yeah, sure.
And as I said, with the smoother transition, the more stable environment, the sellers being able to remain on the board, that helps to preserve company culture and employee engagement going forward, because effectively the sellers can stay in control. Whereas if you sell to a trade competitor or a private equity backed investor, they sometimes may make some radical changes, cost cutting and the like, which creates more uncertainty. And independent research has shown that employee ownership does increase employee motivation, which results in better performance for the company. Company revenues and profitability, generally speaking, goes up.
Yeah, absolutely. And when you said about the seller stays in control, it has an element of control, but once the sale goes through, they do lose control at that point, isn't that right?
Well, they don't have shareholder control, so it's the employee ownership trust that owns a majority, or if not 100%, of the shares in the company. So yes, effectively there is a change of control in the trading company or group.
But it doesn't stop them being active in the business and having input in the business as well.
Correct.
So lots of great benefits there. I think you're right. But I would say that it depends on the individuals that are capable of running that business. Have they run it in the past? And but they will be familiar with the business, and that's where the due diligence really is a lot lighter touch, isn't it? Because everybody knows what will have happened with past risk advice, etc. Let's just look at some of the cons of a scheme like this. What would you think that those are?
Yes, I mean, I wouldn't say there's any obvious cons. I'd say there may be some advantages going to market to try and get an offer from a third party, and those would usually revolve around price, I would expect. I mean, this is your bread and butter, isn't it? Negotiating, the best deal you can for sellers, and often competitors, in particularly private equity backed competitors, may offer a premium to market value. If you're in a competitive bidding environment in particular, you can often ramp up the price. And you may well find that, yeah, you get the consideration paid over a shorter time period than you may otherwise receive it for on a sale to employee ownership trust, where a big chunk of the sale proceeds comes out of future earnings of the company.
Yeah, and that's massive as well. And as you say, some of the big consolidators at the moment have got very big, healthy checkbooks. And I would say they are paying those premium rates. So that's going to be over market value because there's an attraction there. And often deals now are coming out much, much speedier. We've always been used to that sort of 2 to 3 year deals, but some consolidators are slimming that down to 18 months or 12 months, and indeed on one or two are actually coming out with 100% up front. Now, that is what you would miss if you went through an EOT, isn't it?
Yes.
I think the other thing I would say that, again, and I think you were right, they're not necessarily cons, but you miss out on some of the advantage of selling into the external market, and the fact that some of those businesses have really got good tried and tested processes of making sure that clients do stick. Admittedly, an EOT, if nothing is changing much, why would clients leave? But the other thing which gets overlooked sometimes is those economies of scale. And some of those larger businesses, by owning their own platform, owning their own funds, for instance, where their fund manager charges, those TERs can be reduced, and it is those economies of scale. And in a way, that might improve the longevity of a business longer term by being part of that. And of course, it doesn't mean to say selling out, you your staff are going to not be well looked after. Frequently, they get a better deal than they were previously. So I guess it's missing out on those advantages. Would you agree?
Understood. Yeah, I think that's a very good point. Looking at
Fantastic.
the transaction and the future of the business as a whole.
Fantastic. So let's tell us more about setting up an employee ownership trust and the role of the trustees, because they've got quite a big role, haven't they?
Yes, trustees. Getting the right trustees is vital for an employee ownership trust, because the clue is in the name there, really. It's a trust, and as a result, you need what's called trustees who effectively manage it. So you would normally have what's called a company limited by guarantee, which is the trust entity, and then you have individual directors who manage the trustees, effectively, who manage the trust. And their role is not really to get involved in the day-to-day management and operation of the business unless there's a drastic situation, but is more of a supervisory role to keep an eye on what's going on, to ensure that you're complying with EOT qualifying conditions and legislation, which ensures the tax benefits for the selling employee is obviously important, and to consider the finances going forward and when it's appropriate to make payments from the trading company to the trust so that deferred consideration can be paid to the sellers, which sometimes can take 3 to 5 years, maybe more. So the trustees are guided, trusted advisors who help to ensure the management and governance of the trust going forward. And you would often have an independent chairperson, because the sellers, a key point here is the sellers cannot control the trust, the EOT. They can be directors of the trading company, but they can't control the trust. So they can have a role. So you'd normally have maybe one representative from the sellers to act as a trustee, and then you may have an employee representative as a trustee. And then, as I said, at least one independent trustee who would often act as chair and have the sort of casting vote, so to speak, if you needed it.
Do you find, Andrew, that many would appoint a professional trust organisation as a corporate trustee for these
Yes, that's a
entities?
good point. It's so some some sellers prefer not to get involved in the trust at all, in which case you can outsource it completely to a professional trust organisation. The cost may be more, but it takes away any potential conflict of interest between the sellers and their role as directors of the company, but also trustees of the EOT.
So I see the role of using perhaps a professional corporate trustee, but how vital, Andrew, is it that somebody uses professionals to create these trusts?
Yeah, very important in my opinion, and I would say that as a corporate lawyer. But joking aside, the key aspect of this is the tax benefits. So you'd need a experienced professional trust of tax advisor to obtain HMRC clearance up front. You also need sensible lawyers who are experienced with these sort of transactions to draft the sale and the trust documentation, which is very important. And you need independent valuation of the company, at least one independent valuation. Some businesses now actually obtain more than one because there's a legal obligation now under the rules brought in under the Labour government after they were elected, that the trustees must take reasonable steps to ensure that the price paid by the trust isn't above market value. So that's another key aspect. So often accountants or corporate finance advisors like yourself have a role in determining the valuation of the company. So so you still do need professional advisors who will need to be paid for their services, but I would say overall the transaction costs are a lot less than if you were doing a sale to an external party.
Yeah, absolutely. And I suppose it doesn't stop there, does it? Because that just relates to the setting up the trust, but actually it's quite important that the trust continues to be run following all of the rules. So therefore that needs that ongoing management and governance as well, and making sure that you've got good professional oversight, I suppose, to make sure that you're not falling foul of it.
Yes, I mean, I don't think the ongoing costs of the trust need be excessive, particularly if you don't have a corporate professional trust organisation who you're paying to do that role. If you've just got one independent chairperson for the trust, that I wouldn't expect their fees to be extortionate. But it may be that there are matters they think they want to seek guidance from lawyers or accountants on going forward. But I think that the main bulk of the work is involved in setting up the trust and preparing and negotiating the sale documentation.
Yeah, absolutely. And am I right that if there are areas that aren't followed and kept up after, even in the 4-year period after the trust, then the vendor could lose that 100% capital gains tax
Yes,
relief?
that's it's very important to remember that, and thank you for making that point. As that's a time period that was lengthened by the Labour government to say that you've got to comply with these rules for the 4 tax years after you complete the sale. So otherwise, tax benefits may be lost.
Yeah, absolutely. So the other aspect is this tends to suit a more of a longer earnout, doesn't it, or arrangement,
Yeah.
and that there are actual benefits as well for the trust in paying the consideration value for that majority shareholding through trading. Can you tell us a little bit more about that?
Yes. So the initial consideration payable upfront, as I said, is a gift from the trading company, the trading group, out of distributable reserves and profits, and that is tax free. And then the deferred consideration that's paid out of the future profits of the trading company and group, that is also tax free, consider it provided EOT qualifying conditions are met. So it's the same principle, but obviously you need the trading entity to be profitable going forward
Yeah.
to make those payments.
Absolutely. That's the key, isn't it? Making sure it continues to be profitable and can meet those sort of obligations, really. So let's just delve into those qualifying conditions. Yeah, there's just a few, I think, aren't there, that has to be in place as well.
That's right. Yes, I'll touch on them briefly now. The new rules require the EOT to be established and operated in the UK. Offshore trusts are no longer permitted. Secondly, the company must be a trading company or the principal company of a trading group. Thirdly, the EOT must hold a controlling interest in the target company and have majority voting rights, entitling it to more than 50% of the profits and 50% of the assets on a winding up. Fourth, subject to certain exemptions, all employees, excluding the selling shareholders, will be beneficiaries of the EOT, subject to a qualifying period of up to 1 year. Any benefits paid to eligible employees must be on the same terms. However, the trust doesn't have to pay staff members an equal amount. It can allocate benefits of differing amounts according to factors such as the salary and length of service of the eligible employee. So more senior members of staff who've been at the organisation for a long time and are paid more can effectively get a bigger distribution of profits going forward.
It just means that the criteria must follow for all staff, and whatever is set up is that criteria, I guess.
That's right. That's right. As I said before, there's a legal obligation on the trustees to take reasonable steps to ensure the consideration paid by the EOT isn't more than market value. This is very important because setting the price too high, whilst the sellers might think that's a good idea, it risks the trustees being found to be in breach of their duty of care towards the employees as beneficiaries of the trust and may result in failure to satisfy the EOT conditions, and so you may lose your CGT exemption.
Wow. Don't want to do that. Don't want to do that
No,
at all.
definitely not. Definitely not. Yes, and as I said, the selling shareholders and any persons connected with them may remain actively involved in the management of the company, but they're not permitted to control the EOT. So that's an important point for them to bear in mind.
Fantastic.
And as you said, these conditions remain in place for 4 years, 4 tax years after the end of the tax year in which the disposal is made. The ongoing management and operation of the trust is very important.
Absolutely. But, anybody that's going to embark on one of these needs to talk to people like yourself, I think, Andrew, that have been involved with them. You benefit from individuals that have experience of having set them up as well. We talked about the pros and cons. It's not going to be for everybody. You've set some up, and obviously I don't want you to disclose any names or anything like that, but is there any sort of background that you think, well, this is when it really worked? It worked for this type of business. Do you want to sort of share some background on that?
Yes, thank you, Gary. That's a good question. I think sales to EOTs are particularly good when the people are the key assets of the business, which I guess they often are in most businesses. But it's when you've got a workforce that are generating the income and driving the business going forward, as opposed to maybe a more tech driven operation. And that's where you see the real benefits, because you can really incentivize and motivate them going forward. I mean, obvious example is John Lewis. He had Richer Sounds as well, which was a similar organization. And I think these, I haven't seen that many personally, but I think these could work well for financial services and wealth management businesses, IFAs, where obviously the employees, the staff are the key drivers of the business and generate the profits.
Yeah, no, absolutely. And I think particularly for those businesses where they're growth businesses as well, and where there's a good management structure, I can see it really working very well, because those individuals are probably ready to pick up the mantle and become business owners, through the trust. So I can see this working really well. But I do go into many businesses where you might think that individuals would be natural to take on this role, maybe really big producing advisors, fantastic fee level. But actually, this isn't their bag at all. This isn't what they would want to do. They don't want to run a business. They want to stay doing the job that they are. So we'll have to be careful that we don't try to put square pegs into round holes that would not feel comfortable with the ongoing sort of running a business, I guess.
Yes, and I think particularly well suited for family businesses where the company culture and values is something that they want to maintain and preserve,
Yeah.
and where they may have a next generation, sometimes family members, but not always, who they're keen to bring on to take over the running of the business from perhaps the founders or or the people who've been running it for a long time. So I think particularly good for those owner managed businesses.
Yeah, and that's a good point, and we've seen that ourselves with, particularly with a son or daughter that wants to step up, but actually they realise that they can't do it on their own, so they actually involve others within the staff as well, want to take that on. But the parents, yeah, they are reaching their retirement and do want a retirement pot of money from the business itself. So this again would lend itself really well, I think, for those.
I think so, particularly with the changes that are going on to inheritance tax at the moment. There's a bit of uncertainty, isn't there? The Labour government obviously trying to raise more through taxes.
Correct.
This is, EOTs. Obviously, there are. It's not just all about the tax benefits, but that I think I see them being used more and more going forward.
Yeah, absolutely. And something that we don't even know if capital gains tax is going to increase again. We know that there's a big black hole at the moment, and we're talking and filming this in August 25. And, in the next 3 months, we'll probably be enlightened what those other taxes are going to be. But I think on anything, it's about bringing this in as an option. Yeah. And I know what we would do here, and I'm sure other brokers too. It is about understanding what the seller's goals are and then actually tailoring solutions that could work. And I do think, though, that what we should never do is just think saving capital gains tax is the only reason why this should go down this route. It's a bigger thing than that. So work with somebody that can actually look at doing all of that. And what we're finding here is that we will operate on a sell-side broker arrangement if somebody is interested in setting up an employee ownership trust, because there are lots of coordination required. It's about, our role would be here to look at the overall picture, but we can get involved with the negotiation process on both sides. We can make sure that they're put in touch with legal experts like yourself, Andrew, that would be able to create the trust, and making sure that the FCA have the right notifications on changing control as well. Also, we have a great relationship with accountancy partners here as well that can make sure that we're looking at the getting the HMRC clearance, but also we work in tandem with accountants for valuations because we have that bank of knowledge on the valuation side. We know what is available. By every business is separate and individual. It depends on the clients, their ages, their average holdings per household, how that they've been invested, their client proposition for consumer duty, etc. But we also need the accountants to be validating the accounts, making sure that the recurring income is validated and it's as it is. Also that the expenses and the EBITDA is as said. These all go into factoring what is a valuation, and I think we're keen to talk to people that want to consider this as an option. And I know you're a great individual here that can also help to explain how these trusts are created, because you've done it, you've been there, and that's what's important.
Well, thank you, Gary. Yeah, it's kind words. I think that's a good summary, and I think it's complementary skills, isn't it? Obviously, you've got great market knowledge in financial services sector. You understand the multiples that these different businesses can get, and depending on the size of their revenues and the recurring income. And we can help with the tax clearance and the legal documentation, and also helping to source independent trustees as well. I'm a member of an organisation that provides those sort of professionals going forward. So we between us we've got the full holistic service really for any seller. We're always happy to have a chat with people to see if they'd like to find out more and if they think that a sale to an EOT is a good option for them.
Oh, fantastic. Andrew, I really do thank you for your time. This is really great to talk about something different, something new, that hasn't been talked about before. We've not done this on a podcast or a YouTube video before, so this is really good. And just to make sure that the viewers know that both mine and Andrew's contact details will appear at the end of this video as well. So please do get in touch if this interests you, because we would love to chat to you. And also do follow all of our videos here on the YouTube channel by clicking the subscribe button so that you don't miss our next episodes. Thank you ever so much, Andrew, for joining me.
Thank you, Gary.
So, hi, Andrew. Welcome back to our podcast about EOTs. And we're back talking again following the autumn budget on the 26th of November 2025, which they announced a big, significant change to EOTs. So would you like to enlighten our viewers on that change?
Yes. So, as you say, it was a significant change in relation to their tax relief. Previously, sellers would get 100% relief on capital gains tax on their sale proceeds. But that has been reduced to 50%. So, a big change for taxpayers who now have to pay capital gains tax on 50% of the sale proceeds.
And just for the viewers again, so when was that brought in? Because obviously it was announced on the 26th of November.
Yes, it was brought in on the date of the budget statement, the 26th of November. So I was lucky for one of my clients who managed to close a deal, a sale to an employee ownership trust the day before, which saved the seller a significant amount of capital gains tax. But unfortunately, that won't be available going forward.
Wow. And I didn't see that coming, to be honest, because of the changes that happened in the previous budget. And there felt like there was, the government was really behind them. I suppose the big changes before was making sure that it was UK and not offshore trusts, but I didn't see it coming. So well done to you in helping your client. And I believe it was a significant sum of tax saved.
Yes, yeah. I think most sellers would rather keep the sale proceeds as much as they can rather than give them to HMRC. But as you say, I don't think we were expecting it either, because they did make a number of changes last year, including changing the clawback period to 4 years, and as you say, sort of making sure that trustees get independent valuations to make sure that EOTs are paying above market value for the business that they're acquiring.
Yeah. So how do you see this moving forward now, Andrew? Do you see that EOTs are going to be as attractive as they were before?
I think they will still be attractive because it's still a good tax incentive. Perhaps for smaller deals, there's a bit more of thought now, because I guess if you get business asset disposal relief for sales under 1 million, you're now talking, which I believe is 18% tax, as opposed to, I guess, 12% you'll be paying now with a 50% CGT relief. That's not such a huge difference now, I suppose, for those smaller deals, and particularly if you're getting under a sale to employee ownership trust. Sometimes you might get 20-30% of the sale proceeds on day one, with the rest to follow over 3 to 5 years, sometimes maybe more. And so, strictly speaking, you're liable to pay the tax on day one. So, without necessarily getting the guarantee of the deferred consideration. But I understand you can play in installments to HMRC if you agree that with them as part of the
And
tax.
just for clarity, the change in business asset disposal relief to 18% takes place from the 6th of April 2026. So there's still time for businesses to still be able to get the lower 14% if they're quick. Due diligence pretty much will, take up most of that time. So really would need to start the discussion process very, very quickly. But so look, I think there's a place, isn't there? And particularly those sellers that want to set up an employee ownership trust for their workers to take on the business. But I can see that 50% change is going to disincentivize in a lot of ways, because there's so many fantastic deals out there from the external market looking to buy in and offering great quick payouts as well. So we will wait and see.
Yes, particularly in the financial services, the IFA sector, which obviously you're an expert in, with private equity-backed acquirers offering deferred consideration over 2 or 3 years with 50% on day one. Then the multiples that you can get on some of those businesses are still attractive, aren't they? So in many ways, still a seller's market.
Yeah. Well, I think, again, for our viewers, anybody that's interested in looking at EOTs, our contact details are shown. Give us a call and we will help give you some guidance. So thank you very much, Andrew, for coming on and updating us with that change.
Thank you, Gary. Good to talk.